Hope everybody's doing well out there. We're back with another market update, kind of a week in review. So, Quint, what's going on?
Ha! Well, there's quite a few things going on right now in the markets. I'll tell you, it's kept us on our toes the last few days. Let me ask you, though. You've been in this business now for all of, 13, 14 months?
Yep.
I mean, you're relatively new, joking aside. And you've obviously studied this. That was your, entire academic, career, I guess. And then you went off and you were in the corporate finance world for a little while. And now you're in and around the markets. I would say, from my vantage point, watching your career thus far, for the first 11, 12 months, you must have thought, wow, this is a pretty easy game.
Yeah, well, at first I was thinking, no problem at all. But then I start looking at you and I start realizing why you have no hair. I feel like I'm losing some patches back here lately.
Oh, yeah, that's exactly right. Well, I mean, obviously, joking aside, now I will say, and I'm very happy. Look, if you are new to what we do, if you're just starting to read our newsletters or you're new to this, we do not shy away from our opinions or our views. We just don't. And I'm okay with being wrong. I mean, there's times over 20 plus years, there's times I've been dead wrong in views and opinions, but what we don't do is we don't subscribe to other people's opinions. Now, we take them, and certainly there are people that we read or respect their views on, but we don't get a crib sheet from some office in New York saying, this is our view and what you need to say. So I am pleased that I think we've done a good job over the last several months sharing with folks that we think the ride's going to get a little bumpy. Mm-hmm. In fact, what was it, 2 weeks ago? The title of our newsletter piece was Buckle Up, right?
Right.
I mean, I don't think it... So I really hope that anyone watching or that are clients of ours are not alarmed by what they see in the market. It's also a reason, I mean, months ago, we did the video on standard deviation, which I highly recommend you watch, whether you're a client or not, whether you're young or old, it matters not, because it's a great look into the understanding that markets on occasion will move. Yep. And the example I gave was I equated it to the weather. And in the state of Kentucky, we go through 3 seasons in a week. And that's sometimes what the market does. So to answer your question, the markets have been difficult. They've been volatile. And what they're trying to process is the inflationary data that we're getting, which is very high. 7% was the 2021 cumulative CPI, highest in 40 years. CPI stands for Consumer Price Index, what you're paying for. You'd have to be living under a rock not to hear the word inflation. What, year and a half ago? Right when you came in, we started doing the inflation freight train. People thought, I'll never forget, somebody said, being a little extreme with that word, aren't you, a little freight train? I was like, no, that's what we see coming. Now, here's the interesting thing, and this is, I'm going to try to write about this. I'm going to try to extrapolate this out a little bit. But that entire webinar was based on something called monetary induced inflation. Monetary induced inflation is a devaluation of the currency, creating a rise in prices because the valuation of the currency is going down. Okay, now I'm not going to go into the details of how that happens. We did that in the webinar. I've written about that. You can learn about that on your own. The irony of this, the environment we're in, the dollar is strong. The United States dollar value is not going down. And so therefore, why on earth are we seeing 7% inflation? And some groups, oil and energy, 50% last year. You're paying 50% more at the pumps than you were a year ago. Your poultry products, 12.5% higher than they were a year ago. So some areas are autos, used autos, oh my goodness, 40% higher. Okay, so certainly on average it's about 7, or it is 7, but many areas are much higher. So if it's not monetary induced, why are we seeing this? We are seeing this as a direct result of COVID and the supply chain issues. Throw in a sprinkling of free money, okay, which created excess demand. What do I mean by that? Well, we had COVID, shut everything down. Manufacturing was halted. Nobody produced anything, okay, across the world. Then we reopened and everybody said, I want everything now. Plus, many people had money that they didn't have. Like, it was given to them. They could spend it however they wanted. So now you have this mad rush of people going to get products. It's not been produced. Now all of a sudden, everybody wants it and they have money. Okay, the reason that we have these ramps in prices is that equation right there. Now, the Fed, in my opinion, made a tragic mistake when they used the word transitory. They did not qualify how long that transitory word meant, because what they were saying when they looked at the data of CPI, they said, look, the reality is we think over time these are going to come down. Now, newsflash, I actually think they're right. I think they're right in that these things are going to come down. The problem is that in our culture, in our world today, when we hear that something's going to get better, yes, we want it immediately. So they use that word. They set themselves up for that. So now they're between a rock and a hard place. And the market is assuming that to fight inflation, historically, Federal Reserve raises interest rates. Now, again, man, this is just, it's hard to go down. Why do they raise interest rates, Logan, to fight inflation? I'll ask you. Go back to class.
So basically, whenever they're raising the rates, it's going to be harder for people to get easy money. So there's less money in the system, essentially making it harder for people to just spend.
So yes, individuals, you did it from a consumer perspective, but think more broadly. When the Fed raises rates and a corporation is looking at expanding, right, buying or building or doing something, they might go, whoa, wait a second. It used to cost us X to build this wing of our plant. Now we're going to pay X plus whatever. Let's hold off a while. Right. Well, if they hold off a while, that means they're not going to hire that construction company. That construction company's not going to hire all their employees to do that job. They're not going to buy all those supplies. So by raising rates, it slows down the demand, thus reducing the prices. The problem the Fed has, and the problem I have right now, is that I look at the individual elements of the CPI and I go, these aren't going to stay at these levels. They're just not. They're going to come down. So the market right now is pricing in the Fed doing all this action. Oh, the Fed is going to raise 4 times next year, and they're going to do this. And so many areas in the market are getting crushed. And in my opinion right now, it's probably creating an incredible opportunity rather than this warning sign, and here's why. I believe that going into 2022, we will start to see the CPI come down. Whether the Fed has already raised once or not, I don't know. I don't know how quickly the CPI will come down. But the minute that starts to come down, I think the Fed tone is going to change dramatically. And ultimately, when the Fed tone changes, the market's going to increase rapidly. The market is pricing in the Fed doing X, Y, and Z. I'd be surprised if they get to Y. Okay? Now, somebody can say, well, no, and I love this, right? Somebody says, Quint, the Fed is telling us. They're telling us. This is the same Fed who said transitory.
Just a few months ago.
And it's not.
Exactly.
Yeah, and they've come out and said, we're wrong.
Yep.
So come on, let's use our brain. Let's not just assume that because they're in this position, they're right. So, okay, what do you want to know? You want to know, what have we done or what do we do, right?
Right.
Well, look, the reality is knowledge is half the game. Knowledge is half the battle, meaning you got to know we're not in this environment where we go straight up every day, all day long. In fact, the more volatile we become, the more susceptible we become to kind of panic selling. So I suspect we could see some pretty significant volatility on the horizon. We're coming into a 3-day weekend, going to give a lot of time a process, what's happening in the markets, et cetera. Next week could be interesting. Now, that also could mean that by the end of the week, we look and we're a lot higher, right? Because we had a huge decline, whatever. But there's also opportunity. We took the advantage. We had raised some cash near the end of the year for our client, for majority of our passive accounts. We don't do a lot of activity, but at times we will raise capital, or whatever. We took some profits in some areas, and we just added to our emerging market exposure. We just added some exposure there, which I'll tell you is, quite frankly, hard to do because they've stunk. The whole emerging markets for the last several years has been terrible, but there's a variety of reasons I like them a lot right now. Number one, they're cheap. They're very inexpensive compared to historical levels, compared to other markets, United States, etc. But number two, to me, it makes natural sense that with all the prices of commodities on the rise and having been on the rise, whether they come down or not, they've been on the rise. They've been at prices we haven't seen in many, many years. Most of the countries that are going to benefit from that are the countries in emerging markets, Latin America, different Asian countries, et cetera, that sell all of those commodities, whether it be oil, tin, iron ore, aluminum, et cetera. They're mined or produced and sold in those countries. So that's going to impact GDP, investment in those countries, et cetera. So I really like the emerging markets here. We're moving slow. We're not putting all that cash back to work right away.
Right.
I think we could get some craziness here in the first quarter.
Don't undo the seatbelt just yet.
Yeah, there's no one. No, we're not going, let's just buy. But again, I think in summary, it's been a wild ride already in 14 days in January, and I'm trying to remind myself, it's only 14 days. And for some of our more aggressive trading type accounts, oh my goodness, I mean, it's been ridiculous. I mean, it's been very difficult. But again, I think the market is taking extremes to a little bit farther level than they need to, and it's going to produce some incredible opportunities.
Well, there you go.
I didn't let you speak at all.
That's all right. We talked about how stressful this time can be for everybody out there.
So if we continue to do videos every week and we look at Logan and Logan starts losing more and more hair, you'll know that this is really a difficult business. No, the reality is, look, we're going to continue to navigate. We do anticipate that there's certain environments that are just tougher than others.
Mm-hmm.
And it's like my 14-year-old, something can go wrong and I look at it, I go, hey, that's a challenge. And in his world, it's devastation, right? And then, rightfully so. He's young, he's learning, et cetera. The market is a lot like that.
Right.
There's some challenges on the horizon. Markets will often over-exaggerate those challenges. So we'll see what happens. I think we're in a really good position. I feel fine, about the year. And I think by the end of the year, I'm not projecting out 11 more months. Anything can happen. But I don't think we'll look back on this and go, oh my gosh, that was the end of all of this. I really don't. I hope I'm right in that, but we'll see.
Absolutely. So we'll continue to send out content to you all. We'll be writing and hope you enjoy it. So feel free to give us feedback on the things that we're sending out, and we'll see you next time.
Stay tuned for a webinar that we're going to do, kind of a coffee talk webinar, taking questions, et cetera, on the 26th? 26th.
So in a couple of weeks, we should be sending out over the next
couple weeks. But it will fill up fast. So when we send that email, do not wait. Do not hesitate. Sign up for that. All right. Until next time, make it a great day.